Most people misunderstand debt because they only look at the number. They see a mortgage statement and think burden. I see the interest rate, the term, the currency it is denominated in, and the inflation regime sitting above it. And sometimes I see something very different. I see a shield. That sounds strange because for most of your life you were taught one clean moral lesson. Debt is bad. Paying it off early is good. Owing less is freedom. The family with no mortgage is safe. The family with leverage is exposed. That lesson feels responsible. It also leaves out half the machinery. A mortgage is not just debt. A fixed rate mortgage is a contract with time, and in the wrong monetary era for the lender and the right one for the borrower. Time can become the most generous partner on your balance sheet. That is the part almost nobody explains. They reduce the whole conversation to character. They make it sound as if the only issue is discipline, prudence, courage, restraint, but there is another issue sitting right beneath those moral slogans, and it is far more powerful. What happens to debt when the money used to measure it keeps losing strength? That is the real question. I want you to imagine a man who owes 100 pounds of grain, not money. If the grain itself stays just as scarce and useful as the day he borrowed it, then paying it back is exactly what it sounds like. He returns what he took, but if by the time he repays, the grain has been quietly mixed with husks, fillers, and dust until the sack looks the same and weighs the same but feeds far fewer people, then the burden has changed even if the number has not. That is how debt gets paid off in the modern world more often than people admit. Not by heroism, not by honesty, by dilution. The public thinks governments solve debt crises through courage. They do not. Usually they solve them through arithmetic dressed up as policy. They stretch time. They lean on inflation. They tolerate a weaker unit of account. They keep savers docile with nominal returns that look respectable to the inattentive and feel disastrous to anyone who still remembers what purchasing power means. The newspapers call this many things: adjustment normalization, accommodation, policy flexibility. I call it what it is: a silent transfer from holders of idle money to holders of fixed obligations tied to real assets. Once you see that, you start to understand why the wrong kind of discipline can make a family poorer while they feel more virtuous every month. A low fixed rate mortgage in an inflationary regime is not merely debt. It is a claim against the future weakness of money. That is why I want to start by separating two kinds of financial behavior that most people lazily mash together. One is consumer debt, which is usually poison. It funds things that decay faster than the interest compounds. It buys today from tomorrow at a price that insults reason. Credit card debt, reckless personal loans, status borrowing, all of that deserves the hostility it gets. The other is long-duration fixed debt attached to a real productive or shelter asset in a currency likely to lose purchasing power over time. That is a different animal entirely. Treating those two debts as morally identical is one of the most expensive confusions in personal finance. Now let me show you the deeper machine. When governments carry enormous debt burdens, they face a problem that ordinary households understand instinctively. If the interest cost on your obligations rises faster than your income, you are not in control of your life. You are working for the rollover. You are no longer making choices. You are renewing them under pressure. That is where large governments find themselves from time to time. They owe too much. The debt matures continuously. Old low-rate borrowing is replaced with newer, pricier borrowing. Interest becomes one of the fastest growing claims on future tax revenue. At that point, there are only a few ways out: raise taxes sharply, slash spending brutally, default openly, or reduce the real burden quietly by allowing the unit of repayment to weaken over time. Guess which route politicians prefer? The silent one. The route that produces less immediate outrage, the route that can be explained away as growth, resilience, higher nominal wages, healthy target flexibility, or one of a dozen technocratic euphemisms. The history of public debt is full of these episodes. A country borrows in strong money and repays in weakened money. Bondholders receive every dollar promised and still lose. Savers watch their statements grow slowly, while their purchasing power erodes quickly. Salaries rise later than prices. Cash sits obediently in the bank and shrinks in real terms. And anyone who locked in cheap long-term fixed debt against a real asset wakes up every year owing the same number in a weaker measuring stick. That is the gift. It is not glamorous. It does not arrive wrapped with a ribbon. It arrives 1 month at a time while people who do not understand the system keep rushing to be debt-free by sending scarce hard-earned dollars back to the bank faster than the contract requires. They think they are reducing risk. Often they are surrendering one of the best inflation hedges they will ever be offered. This is where moral language does enormous damage. There is a certain kind of financial entertainer who likes simple slogans because slogans travel faster than structure. They say things like, "All debt is slavery," and audiences cheer because simplicity feels like truth. But money is not a sermon. It is a set of interacting contracts living inside a policy environment. A mortgage at 3% fixed for 30 years is not the same as a credit card at 24%. A house with stable financing is not the same as a sports car bought to impress people you secretly dislike. If you refuse to distinguish among these, the world will distinguish for you, and usually at your expense. What matters with a mortgage is not just that you owe money. What matters is what rate you owe, for how long, on what asset, against what inflation backdrop, and with what alternatives for your cash. Those are the adult questions. Suppose you own a house financed at a long fixed rate that is well below prevailing inflation and not far above the average rate paid on risk. Free cash, your monthly payment is set, your principal schedule is set. The lender will not call next year and ask to rewrite the terms because groceries cost more. The contract is indifferent to inflation. Your life is not. Your wages, if you are employed, may rise over time. Your business revenue, if you own one, may rise. Your rents, if the property is an investment, may rise. The replacement cost of the underlying house almost certainly rises over the long sweep of years because labor, materials, land, and regulation rarely move in reverse. For long, the mortgage payment does not rise. Read that line again because that is the center of the whole thing. The asset side of your life adjusts. The payment side of this specific contract does not. That gap is where a great deal of quiet wealth is made. Not in the first month, not in a flashy year, over long periods. In the background, in plain sight. While everyone else is busy discussing whether they should feel comfortable owing money. Comfort is not a financial metric. Spread is, real borrowing cost is, optionality is. The family that locked in cheap long-term debt and kept liquidity on hand may look more indebted on paper than the family racing to extinguish their mortgage. But if inflation stays structurally higher than the rate on that debt, the first family is actually positioned to let time do part of the heavy lifting. The second family is handing the bank stronger dollars today in order to retire a liability that is becoming easier to carry tomorrow. That is not prudence. That is reverse arbitrage performed for emotional relief. Now, I am not saying nobody should ever pay off a mortgage early. There are real cases where it makes sense. A person with unstable income, weak reserves, a variable rate loan, a very high mortgage rate, or poor discipline with spare cash may rationally choose simplicity over optimization. Peace of mind matters. Sleep has value. A household that would otherwise squander liquidity on junk consumption may be safer forcing itself into equity. I have no interest in ignoring human weakness for the sake of winning a spreadsheet contest. But I do object when people turn a context-specific decision into a universal commandment. That is how ordinary savers get quietly harvested. Harvested is the right word because in the same environment that makes low fixed rate debt attractive, idle cash becomes vulnerable. This is the part that ties the whole structure together. If policymakers need the system to digest very large debt burdens, they need savers to accept returns that lag the erosion of purchasing power. They need people to feel patient while becoming poorer in real terms. They need balance sheet conservatism to drift into economic passivity. They need grandma to feel safe in the savings account. They need the retiree to feel proud of the CD ladder. They need the household with excess liquidity to believe that nominal stability is the same thing as real preservation. It is not. A bank statement is a very good liar because it speaks in nominal language. It says you still have a balance. It does not say what that balance has stopped being able to buy. This is why I have always distrusted financial advice that praises cash without asking. Cash relative to what? Cash for flexibility. Yes, cash for emergency reserves. Yes, cash as dry powder. Yes, cash as a forever solution in a regime of deliberate monetary dilution. Absolutely not. And this is where the low-rate mortgage becomes so interesting. It is a rare contract that turns the system's preferred strategy back in favor of the borrower. If inflation is the solvent used to soften sovereign debt burdens, then your mortgage benefits by proximity. Not because anybody in Washington loves you, not because the central bank woke up wanting to improve your family's life, simply because you and the sovereign are being measured in the same weakening units. Debt is debt. If the measuring stick weakens, both burdens are lightened in real terms. That is the hidden alliance. The borrower with long fixed debt and the government with long debt exposure are not identical, but they are standing on the same side of one very important river. They both benefit when repayment happens later in weaker money. The saver sitting in a near zero yielding account is on the other bank of the river. He thinks he is dry because his statement is stable. In reality, he is funding the crossing. I want to be careful here. This is not an invitation to be reckless. It is not an argument for max leverage. It is not permission to turn your house into an ATM and start treating equity like confetti. Anyone who heard that from me would be hearing what they wanted, not what I said. The right lesson is subtler and more durable. If you already possess a long-term fixed rate mortgage at an unusually favorable rate, you may be holding one of the best assets on your household balance sheet. not because a mortgage is intrinsically beautiful, but because the contract is asymmetric in an environment of currency leakage. The next intelligent move is not to worship the mortgage. It is to stop sabotaging the advantage. That begins with one simple act: pull the amortization schedule. Look at it carefully. Look at what you owe in year 10 and year 20. Then place it next to the likely path of nominal wages, nominal rents, nominal replacement costs, and the purchasing power trend of the currency itself. Most people have never done this exercise honestly. They have only stared at the total interest column and felt morally offended. The total interest column is emotionally loud and economically incomplete. It tells you the price of borrowing. It does not tell you the value of optionality. It does not tell you the value of retaining liquid capital. It does not tell you the value of repaying in future money that is likely weaker than present money. It does not tell you what that same capital could earn, preserve, or protect elsewhere. Those omissions are enormous. The second move is to compare your mortgage rate to your cash drag with brutal honesty. If you are paying 3% on fixed debt and earning almost nothing on large idle balances, you are already living inside the transfer. The question is whether you understand it. If inflation is running above your savings yield and not far from or above your mortgage rate, then your safe money is losing the race while your debt is quietly becoming less heavy in real terms. That is the kind of arithmetic people ignore because it offends their moral training. The moral training says savings good, debt bad. The arithmetic says low fixed debt and weak money can be extraordinarily useful while lazy savings can be punished invisibly for years. Adults follow the arithmetic. The third move is to decide what your house is supposed to be in your larger operating system. Is it simply shelter? Is it an asset anchored to favorable debt? Is it a source of optional liquidity through a line of credit or a later stage equity strategy if used carefully? Is it a stability anchor that allows you to take intelligent risk elsewhere because your largest payment is fixed and predictable? These are not glamorous questions. They are far more profitable than glamorous questions. One of the biggest mistakes people make is treating home equity as if it only has two modes, either untouchable virtue or reckless extraction. Real life is more sophisticated. There are times when carefully accessing some stored equity while preserving the favorable debt structure makes sense. There are times when it does not. The point is not to glorify borrowing more. The point is to understand what exactly you own, what exactly you owe, and which parts of the structure are helping you. That is what most people never learn. They look at the house and see an object. They should be looking at the contract and seeing a machine. The machine can work in your favor or against you, depending on the rate term, inflation regime, and your own behavior. Behavior is still the final gate. A brilliant mortgage structure cannot save an idiot with spending habits that turn every advantage into lifestyle creep. If a household uses the breathing room created by favorable debt to buy nonsense, then yes, the system will still win. If they use it to build reserves, buy productive assets, stabilize cash flow, or reduce exposure to more dangerous forms of debt, then the same mortgage becomes a strategic ally. This is why rich people often appear less allergic to certain kinds of debt than poor people. It is not because the rich are immoral. It is because they understand hierarchy. They know the difference between toxic debt and useful debt. They know the difference between borrowing against consumption and borrowing against time. They know the difference between paying off a liability and destroying an asymmetry that was benefiting them. Most of all, they know that in a world of inflation, policy drift, and recurring public debt pressure, the person who understands contract structure usually beats the person who only understands the slogan. Now let me tell you what I think the average saver gets wrong emotionally. He believes his mortgage is the enemy because he can see it every month. He believes his savings account is the friend because it reassures him every month. That is precisely backwards in the wrong regime. The visible payment feels painful. The invisible erosion feels harmless. But finance does not care what is visible to your nervous system. It cares what compounds. A mortgage fixed below the real rate of inflation can be your quiet accomplice. A cash pile earning less than inflation can be your smiling executioner. Once you understand that, your questions improve. You stop asking, should I hate debt? You ask which obligations become easier under monetary dilution and which assets become weaker while they appear safe. You stop asking, how do I feel about my mortgage? You ask, what is the real cost of this debt after inflation, taxes, alternatives, and optionality? You stop asking, would it feel good to be debt-free? You ask, what is the opportunity cost of turning one of my best contracts into a memory? Those are richer questions. And once you ask richer questions, the entire map changes. The house is no longer just a house. The mortgage is no longer just a bill. The savings account is no longer just prudence. The central bank is no longer a distant institution that moves rates in the abstract. It becomes an actor altering the value of every contract in your life. That is how adults should think about money. Not sentimentally, structurally. If I had to compress the whole lesson into one sentence, it would be this. In an age where debt burdens are more likely to be softened through inflation than eliminated through sacrifice, the saver in weak yield cash is often carrying more hidden risk than the homeowner with low fixed debt on a real asset. That sentence will annoy many people. Good, useful truths often do. The purpose of thinking is not to comfort inherited slogans. It is to see the machine as it is. And the machine right now is telling a very old story. Governments with too much debt tend to prefer weaker money to cleaner pain. Banks and savers do not advertise that story because they profit from your confusion. Mortgage lenders will gladly take your strong dollars early. Deposit gatherers will happily pay you nominal crumbs while your purchasing power decays. Advisors who never distinguish between kinds of debt will keep reciting morality plays because morality is easier to sell than mechanism. Meanwhile, the prepared borrower sits quietly in the middle of the storm paying yesterday's rate with tomorrow. That's weaker dollars. That person is not a lucky. That person understands what contract he signed. If you are one of those people, do not rush to undo it just because someone with a microphone confuses discipline with acceleration. Study the terms, study the regime, study your alternatives, protect liquidity, avoid stupid debt, but do not volunteer to destroy a favorable long-term fixed contract simply to satisfy a slogan that was never written for this environment. The world changes. When the environment changes, good advice must become more precise, not louder. And in this environment, precision says something many people still resist. Your low fixed rate mortgage may not be the chain you think it is. It may be one of the few contracts in your financial life that is quietly, patiently, and legally working on your side while the currency itself does the heavy lifting. That is not magic. That is arithmetic. And arithmetic is a much better friend than emotion when the value of money itself is drifting underneath your feet.